Hi, my name is Elliot Yu, co-founder of Capitalist Times Investment Research and Energy and Income Advisor. Today I want to talk to you about smart bonds. This is a brand new service we've created that's designed for individual investors seeking high yields with low volatility and far less downside risk than what's available in the stock market. Put simply, in smart bonds, we track exchange-traded funds, ETFs, that focus on specific niches of the bond, fixed income, credit, and preferred stock markets. Buying these ETFs is as simple and inexpensive as picking up shares of a large cap stock like Apple or Exxon. The average yield of the ETFs we've identified for the model portfolio in smart bonds is above 6%, well above 6%. And we've uncovered a few funds with yields of near, even above 10% that are attractive buys right now. Better yet, over the past year, the average volatility of the ETFs we recommend in smart bonds is about 65% lower than that of the S&P 500. Strong income with low price volatility. So at this point, you might be wondering why anyone would consider investing in bonds right now. Listen to the mainstream media, and you might suppose the past few years have been terrible for bond markets, thanks to tighter Fed policy and rising interest rates. After all, bond prices and yields move in opposite directions. Rising yields means falling prices. So the surge in prevailing interest rates and bond yields from historic lows in 2020, 2021 to two-decade highs in 2023, 2024 means that by definition, some classes of bonds have been hit hard. Now this point is absolutely crucial. Just because some widely tracked treasury and corporate bond indices are down doesn't mean all corners of the bond, fixed income, and credit markets have produced poor returns since the end of 2020. You may or may not be familiar with my work or that of my colleague and co-founder Roger Conrad. However, at the core of all the research publications I've been involved with over the past 25 years is a guiding principle of selectivity. Now that's stock selection in most cases, and that's crucial to long-term investment success. Investors familiar with the stock market know that in any given period of time, there are clear leadership and clear laggard groups. For example, from the end of 1999 through the end of 2009, that's a period of one full decade, the S&P 500 fell more than 9%, including dividends. So, buy and hold investors who bought the market, or an ETF like, say, the SPDR S&P 500 fund ETF that trades under the symbol SPY, they actually lost money for that entire decade through the 2000s. However, an investor who bought the S&P 500 Energy Index enjoyed a respectable gain of over 148%, including dividends. That's more than 9.5% annualized, not bad at all. Consumer staple stocks were up 66.3%, and utilities were up 61.2% on the same basis, while the S&P 500 Information Technology Index and the S&P 500 Communications Services Index were both down more than 50% over that decade, even including dividends paid. So the key to profitability in stocks through the 2000s, and really any other decade in history for that matter, was to understand and concentrate on buying the leaders and avoiding those laggard groups like tech back then. Regardless of the industry, our guiding principle is always to identify the underlying trends that are generating the most profitable growth and recommend the stocks best levered to those trends. Companies best positioned to generate strong dividends and growth given prevailing economic and market conditions. Now, much the same can be said for the bond market. The bond, fixed income, and credit markets, like the stock market, aren't some sort of monolith. Not all corners and niches of these markets move in the same direction, at the same time, or at the same speed. The pundits who tell you the bond market has been getting crushed, or that bonds and stocks now always move in the same direction, are mainly talking about U.S. Treasuries, U.S. government notes and bonds, like the 10-year Treasury or the 30-year. Some may be referencing indices like the Bloomberg U.S. Aggregate Bond Index that tracks treasuries and some investment-grade corporate bonds. And yes, 2022 was the worst year for treasuries and the Bloomberg Aggregate Bond Index in at least the past 50 years. Of course, it wasn't great for the stock market either, with the S&P 500 down more than 18%, including dividends, which was its worst return since 2008. However, investors who purchased the SPDR Bloomberg 1 to 3 month Treasury bill ETF trades under the symbol BIL. Now that's an ETF that tracks short-term US government bonds with maturities of less than 1 year. That ETF managed a 1.4% gain in that dismal year of 2022, into the teeth of a historic bear market in bonds and stocks. A second ETF we recommend in the Smart Bond portfolio right now tracks a rather obscure corner of the US corporate bond market, a profitable niche that was very tough for individual investors to access cost effectively just a few years ago. What's important is that it's a corner of the investment grade corporate bond market that benefits from rising interest rates from Fed rate hikes. Take a look. So this chart shows the cumulative total return, again that's capital gains, price gains, and dividends or distributions, for the S&P 500 as an orange line. The Bloomberg US Aggregate Bond Index I mentioned earlier is shown as a green line, and the corporate bond ETF I just talked about that benefits from rising interest rates is represented by that blue line. The period I've included here is from the end of 2021 through the end of 2023, last year. As you can see, both the Bloomberg Aggregate Bond Index and the S&P 500 had a rough ride over this time frame. And over this 2-year period, the S&P 500 returned just 3% in total, not annualized, total return. While bonds on this basis, that's the aggregate bond index, were down about 7 or 8%, again, including yield. However, just look at this obscure corporate bond ETF I just mentioned. The ETF never fell more than 2.3% in 2022. That was the maximum peak to trough decline on a closing basis. The blue line in my chart is far less volatile than the orange or green lines representing the S&P 500 and that Bloomberg Aggregate Bond Index respectively. And this ETF was up about 8% over this period as a whole, beating the S&P 500 by a 5% margin with far less risk and volatility. Today, this fund still offers a yield over 6%. And this is a bond exchange traded fund right in the teeth of what was supposedly the worst bond market in over a half century. Now, over the past year, while the so-called experts on financial television tell you the bond market is getting crushed, we've identified plenty of bond ETFs that have generated some serious income and capital gains. Our top preferred stock ETF, with a yield over 6% right now, offers protection against rising rates and is up more than 14.2% over the past year alone. Or how about a unique, under-the-radar niche of the corporate bond market that's generated total returns well in excess of 300% since 2006, beating investment-grade bonds, high-yield bonds, and treasuries over that time frame? Our favorite ETF tracking this space is up almost 12% over the past year alone, and it offers a yield of around 6% right now. How about yields closer to 7.7% in an ETF that tracks a compelling floating rate credit market? This fund is up more than 17% in the past year alone, and almost 23% since the end of 2022. Now, not long ago, there were only a handful of exchange-traded funds, ETFs, out there that track the bond market, and most focused at that time on indices like that Bloomberg Aggregate Bond Index, various treasury markets, or certain segments of the corporate bond market. Almost half the ETFs we recommend in the Smart Bonds model portfolio right now were listed for trading after 2020. and more than 2/3 are less than a decade old. Now, Smart Bonds is a culmination of a research project we started about 18 months ago. As I said, this was a time when most pundits were pounding the table about how bad bonds were as an investment. Indeed, the extreme consensus bearish view about bonds and all related income investments is what prompted us to take a look for an opportunity in this market. We started by developing a list, an investable universe of bond, fixed income, and credit ETFs that fit our minimum investment criteria. Now, these were not necessarily ETFs we liked, but ETFs with a reasonable structure and adequate liquidity for individual investors. We found over 300, and there are more listed every year. The truth is that there are bond, credit, and fixed income ETFs that can benefit from virtually every imaginable economic and market environment, from recessions to economic booms, periods of rising or falling interest rates, and equity, stock, bull, and bear markets. Individual investors can now easily gain access to profitable, under-the-radar corners of the bond market, offering high yields as high as 10%, that were only accessible to institutional investors just 5 years ago. And individual investors can move from one corner of the bond market to another with a few clicks of the mouse to respond to changes in the market, economic conditions, and interest rates. And yields are no longer depressed across the board as they were as recently as early 2022. Quite the opposite. We've uncovered myriad low volatility ETFs offering yields north of 5%, a handful with yields around 8%, and even a smaller number, as I said, offering those mouth-watering yields close to or above 10%. Even better, most pay distributions on a monthly basis, so you can expect monthly distribution checks from these ETFs. As I said, in Smart Bonds, we started with an investment universe of more than 300 ETFs that met our minimum volume and liquidity investment criteria. We've now narrowed that list down to create 3 specific model portfolio allocations in Smart Bonds, selected based on our current market, economic, and interest rate outlook. Now, our baseline Smart Bond model portfolio includes 15 bond, credit, and fixed income ETF recommendations with a weighted average yield over 6% right now and volatility that's approximately 60 to 70% lower than the S&P 500 over the past year. Our defensive portfolio allocation is focused on stability of principal and designed for more conservative investors. The weighted average yield is around 5.75%, so a bit lower than our baseline portfolio, but we've really designed this allocation to weather just about any feasible market storms, from recession to further rate hikes and an economic boom and more inflation. Finally, there's our Smart Bonds dynamic 60/40 portfolio. Now, we're really excited about this one. Traditionally, the 60/40 portfolio is a portfolio 60% invested in stocks, usually the S&P 500, and 40% in a broad portfolio of bonds, such as that Bloomberg Aggregate Bond Index I talked about a little while ago. Now, some so-called target date retirement funds, which you may have heard about, change the stock and bond allocations over time based on investors' age and intended retirement date. Now, the idea of the 60/40 portfolio or these so-called target date retirement funds, which have attracted well over $3 trillion in investment funds in the US alone. Now, the idea here is to mix the superior return potential of the stock market with the safety, stability, and income, consistent income of the bond market to produce a sort of all-weather portfolio. And the idea is that the closer the investment gets to retirement, the more they hold in so-called conservative safe bonds and the less they have exposed to the stock market or the S&P 500. However, while that seems like a great idea, right? These strategies suffered their largest losses in at least a half century in 2022 as the S&P 500 stock index and the broader bond market indices were both crushed at the same time. The S&P 500 down more than 18%, that Bloomberg Aggregate US Bond Index down between 12 and 13% in the same year. Now that's particularly painful for those close to retirement who had been relying on a high bond allocation in their portfolio to preserve their capital. Rather than allocating money to stocks and bonds based on some ridiculous, arbitrary calendar-based schedule, our dynamic 60/40 approach makes two simple yet powerful alterations to the basic 60/40 strategy. First, instead of placing the bond allocation of that 60/40 portfolio into treasuries or an aggregate US bond allocation, we're allocating the Smart Bonds Dynamic 60/40 portfolio, the bond portion of it, to the bond ETFs that we hold in the baseline Smart Bonds model portfolio. Second, instead of holding a fixed 60% of the portfolio in stocks or altering it over time based on some arbitrary age-based schedule, we'll allow the stock portion of the portfolio to range from as little as 20% of the total portfolio to as much as 80%. And we're making these allocations based on our assessment of broader economic conditions and market conditions. Now, the recommended stock allocation will be based on a handful of systematic trend-following indicators we follow with a discretionary override. So when these simple trend indicators are bullish, we'll start at a baseline stock allocation of 60%. Good old standard 60/40. That's where the discretionary factors we monitor come into play. Based on our outlook for the economy, inflation, rates, and markets, including a series of economic indicators we've watched and monitored for years, we'll increase or decrease the stock allocation by as much as 20%. So the allocation when the trend indicators are bullish could be as high as 80% or as low as 40%. When the long-term trend is bearish, in contrast, on this basis, we'll start with an equity allocation of 40% and use discretionary factors to adjust that by as much as 20% higher or lower. So in that scenario, the equity allocation could range from as little as 20% to as much as 60% based on our economic and market outlook. So I'd like to invite you to join us in seeking high yields with low volatility by giving our brand new Smart Bond service a trial. Here's how it works. Scroll down below this video and you'll see 3 subscription plans. There's an annual subscription plan at $299 a year, a 2-year plan at $449, and even a lifetime subscription available at $597. Click the blue subscribe button below your preferred plan to go to our secure subscription page. Once you're signed up, we'll rush you our inaugural issue of Smart Bonds, which is a detailed, convenient PDF file. It includes our investment philosophy, a detailed rundown of all the high yield, low volatility bond, fixed income, and credit market ETFs we recommend, and of course, our 3 model portfolios that I just outlined. Now, each model portfolio includes specific advice not only on which ETFs to buy, but where to buy them and how much weight to place in each ETF we recommend. Now, we'll be releasing a detailed Smart Bonds report, including portfolio updates and performance reviews each quarter. As I said, I'll include a full portfolio review and a market outlook. And of course, those quarterly reports will be supplemented by more frequent flash alerts and updates with new recommendations, advice or changes to existing recommendations, and our thoughts on important news or market moving events. Best of all, you have a full 60 days to try Smart Bonds with absolutely no risk or obligation. If you decide the service isn't for you for any reason whatsoever, simply call or email us and cancel your membership for a full refund with no questions asked. I guarantee it. Now, after 60 days, if the service no longer fits your needs for any reason, you can cancel your membership for a prorated refund of your remaining subscription term. Please understand this is a special VIP introductory rate for the brand new Smart Bond service. We're planning to raise our subscription rates later on this year as we open the service to more members, more new members. You'll never see us sell Smart Bonds for a lower price or with more generous risk-free trial guarantees. So I hope you found this presentation useful and interesting. To give Smart Bonds a try, simply click one of the subscribe buttons below the video or give us a call toll-free at 1-877-302-0749 to sign up for your risk-free trial to Smart Bonds over the phone. Thanks for listening, and here's to your wealth.